Are you guys here for the halftime show?
Oh, no. We're here to help people customize and save with Liberty Mutual.
So that's why the emu is here?
Yes. And the emu has a name. Only pay for what you need.
Liberty, 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 liberty.
Cascade Platinum Plus has the grease-fighting power of Dawn to remove tough, stuck-on foods. Cascade Platinum Plus.
I have a 3-step formula that I backtested thousands of times, and every single month that I tested it, it was profitable in the long term. No indicators, no patterns, just pure price action, baby.
That really is the fun part of this whole technique. I have no pleasure just beating the brush. Anybody in the country.
And by the end of this video, you too will know the strategy. We'll be calculating trades just like this one, making insane amounts of money. Jump right into it. The first involves market structure. This is really one of the most important steps, because if you even just slightly f this part up, it ruins the strategy.
Oh, nah, dog. Come on, man.
What very first thing I learned as a trader is uptrends, downtrends. It's almost a sippy cup of trading. A chart that makes highs and higher lows, an uptrend. A chart that makes lows and lower highs is a downtrend. Simple. Everybody knows this. Now you may be thinking, you're even going over this. I already know all this. Well, what if I told you you're probably doing all of this completely wrong? Let me explain. So back to our example, the chart does this, making higher highs and higher lows. And as we already stated, it's an uptrend. Okay, but then something interesting happens. The chart starts heading downwards, which in this process, price makes this low and breaks through it. And this exact point is where I see the majority of traders make the mistake. Since price broke this low, a lot of traders think we are now in a reversal and price is in a downtrend. So in return, they start looking for short trades because they now think price is going to head lower. But what if I told you this chart is actually still fundamentally bullish? You see, sure, price made this low, but this low is actually not a low at all, or at least a valid one. Why? Because price never broke the valid low, which is right here. I want to make this very clear. In order for a low to be validated, it needs to break the previous high. If you do not understand this part of the strategy will not work.
You are done. Fired.
So say if price does break this high, we now know this is a valid low. Okay, good. So now price is in an uptrend, which means we should only look for bullish trades. The only time we should start looking for short trades is if price breaks this low. It can do anything right here. It can go up, down, sideways, literally anything. As long as it doesn't break this low, we are in an uptrend. Now say if instead of doing this, price did end up breaking upwards. Since price did break our previous high, our new low will be transferred from this point to this one. So that's the first step, identifying if we are in an uptrend or a downtrend.
So what's next?
That would be step 2 in the formula. Step 2 is identifying supply and demand in the markets. Demand zones take place in uptrends, supply zones take place in downtrends. A good style of thinking is you want to buy from demand zones and sell from supply zones. Here, if we look closely, the market is going up. Since we saw a large push from the beginning of this move, it simply shows us that a lot of people wanted to buy from this point onward. So we can assume if price comes back down to this area, traders will have the same style of thinking and want to buy in the same area again.
Nice.
A supply zone is the exact opposite. Since we saw a large downwards move from this point on, it shows us that a lot of people want to sell at this area. So if price ever retests this zone, we can assume price will again move downwards from this point. This supply and demand theory is the core of our strategy. But we still have one more step in our 3-step formula. But let me show you some trading profits real quick. I made a video the other month saying I was gonna try to use Hanker Trade's copy trading feature, where you can copy professional analysts by simply simply clicking a button. Now, when they first asked me to test this, I was a little skeptical at first. I'm not gonna lie, but I decided I wanted to test it out for myself. What I did was click this top performing section, so I only saw the top performing analysts. I then saw this guy that had an 86% win rate, so I decided to test him out. I tested this by depositing around $50,000 a month ago. That $50,000 is now $160,000 just from clicking a follow button. Pretty insane. I'll proceed to update you guys on Instagram on how the copy trading is doing.
New face filters on Instagram today. This is my favorite one so far. Nice job, team.
But in the meantime, if you want to test the copy trading feature too, I'll leave a link in the description so you can check it out. Okay, let's go back to the video to a real life example using the strategy I just taught you. So looking at a real chart, we see price moved upwards, came down, and then broke this previous high, which means we have higher highs and higher lows, meaning we're in an uptrend. Since we're in an uptrend, we only look for long trades. We do not look for any sell positions, as shorting in an uptrend is just silly. Since this low broke the previous high, this is our valid low, and price will only be in a downtrend if it breaks this point. So now that we know we're in an uptrend, we want to look for demand zone opportunities. We can find our demand zones by finding an area of consolidation or a point where price moves sideways for having a sharp move upward. As you can see from this chart, we had some consolidation right here. The price shot straight up afterwards. How I like to mark my demand zones is marking the candle right before the impulsive move. So grab your rectangle tool on the side, find the area of consolidation before the big move. Then mark from the low to the high of the previous candle before the big move. This is our area of demand. Again, we are not even considering areas of supply because we are in an uptrend.
As a parent and a healthcare provider, I'm voting yes on 310 to protect our kids from big tobacco.
We love Denver, the freedom, the ability to thrive. We're all in this together. As small business owners, we support our families and we generate tax revenue for the city. Now they want to take that away. Family businesses would be closed, workers laid off, while Denver is cutting services. We should be able to make our own choices. Vote no on Referendum 310.
Paid for by Citizen Power.
Can your pad absorb everything and stay fresh? Always Flex Foam can. It's the only pad made with the flexible foam core that locks in blood and sweat while the top stays dry, keeping you up to 100% leak and odor free. See what foam can do for you.
So we don't even need to worry about that. We wait for price to re-enter into the zone, and this is where we would enter. Set your stop loss right below the demand zone and set your take profit at the recent highs. Boom, we got an easy winning trade. So that's an example of just one winning trade, but I want to show you just how accurate the strategy really is. So let's break it down with the real chart example. Here we have an uptrend because price is making higher highs and higher lows. So as we can see, this low is what broke the previous high. So this is where price needs to break in order to be in a downtrend, which is exactly what ends up happening. So now we are in a downtrend and we only look for areas of supply or short trade. So in return, we mark our areas of supply. Price comes back up to this zone, we enter, set our stop loss right above the area of supply, and set our take profit at the recent low. Boom, we got an easy winning trade. But wait, we're not done. Price created another area of supply up here, and we're still in a downtrend. So we wait for price to come up to the supply. Enter, set our stop loss above the area of supply, target recent lows, another winning trade. But again, we're still not done. Price created another area of supply, wait for price to come up to it, set stop loss above the area of supply, set take profit at recent lows, and again, we have another winning trade. But wait, there's more. We got another area of supply, wait for price to come up here again, set your stop loss and take profit, and we got another winning trade. That's the power of this strategy. It's extremely accurate for one, and two, you're only trading in the direction of the trend, which raises the probability of you winning a trade by a lot. So now that you know just how powerful this strategy really is, let's go to the third and final step on how to improve the strategy even more. Our last step involves risk to reward. Sometimes while using this strategy, you'll get a trade that checks all the boxes, but when you set up your stop loss and take profit, it has a low risk to reward like in this example. We only want to take trades if the risk to reward is above 2.5 to 1, meaning for every $250 we're getting back, we're only risking $100. So even if the chart follows both step 1 and 2, but the risk to reward is under 2.5, we do not take this trade. This one rule by itself increases the profit rate of the strategy by a ton. So for our final example, we have price making higher highs and higher lows, meaning we're in an uptrend, so we only mark areas of demand. Price ends up consolidating right here before shooting upwards, so we mark this area. We wait for price to come to this area again, and then we enter. Set our stop loss below the demand zone and set our take profit at the recent high. Our last step is to check the risk to reward and make sure it's over 2.5, which in this example it's 3, so we're good to go there. If it's anything under 2.5, we do not take the trade. Wait for price to play out and we get a beautiful winning trade. Then we just repeat the process forever.
If you don't know how to play with time frames, you simply don't know how to trade. It doesn't matter if you're a day trader, scalper, swing trader. If you can't properly top-down analysis a chart, you cannot trade. It doesn't matter what type of trader you are. And if you want to be able to be a sniper trader and constantly win in the markets and become profitable, you have to be able to properly do a top-down analysis in the market so you can actually see what the market is doing on different time frames. Now, before you become into a nerd or want to be expert on only one single time frame, I need you to realize that there's not only one time frame to be successful. You need to be able to manage multiple different time frames at the same time. And these are the main key time frames that you need to know for a top-down analysis. That is going to be the weekly time frame, the daily time frame, and the 4-hour time frame. It does not matter if you're a scalper, day trader, swing trader. You need to have these 3 main time frames in your top-down analysis so you can properly understand the direction of the market, where it's headed, and how you can find an edge in the market. So now let's get into the video on how you can properly do a top-down analysis, and I'm also going to show you how to actually enter a trade with my personal entry signal that I use every single time I enter a trade, and it raises my win rate by even 20 to 25%. So if you have a win rate of 40 to 50%, if you just add this extra entry stuff that I use, you're gonna boost your win rate by 25 to 30%, which can lead you to about a 70% winning strategy, which is crazy. So now let's actually get into the markets right now, where I'm gonna show you how to properly do a top-down analysis and you can actually have an edge over the market. So let's get into it. So first things first is going to be the actual time frames to do the top-down analysis. So there is hundreds of different time frames. You have the 1 minute, the 2 minute, the 3 minute, 5, 15. You have all these different time frames. You can almost even create custom time frames of your own liking, which is actually, kind of bizarre. Doesn't even make any sense in my opinion, but the possibility is there. And then also you can go down to the seconds and how many seconds and stuff, which is absolutely just ridiculous. If you notice here, I have a star on every single time frame that I personally use. For every single time I do a top-down analysis on any pair on my watch list. So this does not matter the currency pair that you're trading. It doesn't matter if it's GBP USD, Euro USD, GBP JPY. The same top-down analysis applies to any pair, any commodity, any future. Everything is exactly the same because it just consists of a top-down analysis. The simple analogy that I can put here is if you were to take a car into a shop to do the oil change, it has to pass by the same exact inspection. They have to see how much oil is in it, how old is the oil in there, how many quarts of oil have to be added, and what type of oil. It's the same thing. Doesn't matter if it's a Rolls Royce or if it's a Honda Civic. They have to go through the same oil process to have the standard of what they should do next. Same thing here. You have to go through the standard of what the time frames are doing to determine if you're interested in taking this trade. So these are going to be the main time frames that I use, which is the 15-minute, 30, 1 hour, 2 hour, 4 hour, daily, weekly, and monthly. So I put a star on them so they stay on this top section here, and I only focus on the ones that are needed for a proper top-down analysis. So first things first, what is a top-down analysis? Well, it's pretty self-explanatory. You have to start from the top down, right? It's a top-down analysis. So you want to start off from the highest of the time frame and work all your way down. So you were to start off from the weekly, Then after the weekly, you would go to the daily. Then from the daily, you would go to the 4 hour, the 4 hour, 2, 1, 30, 15 minute. It's just pretty much a ladder that goes from the highest time frame to the lowest time frame. But there's actually a very specific way on how to do it and what time frames you divide from each. So don't worry, it's gonna make sense in literally just a second. So for this video, we're going to be using the weekly, the daily, the 4 hour, the 2 hour, the 1 hour, the 30 minute, and the 15 minute. So this is actually divided right down the middle, almost pretty much. And it's divided right at this section right here. Why, you may ask? Well, that is because the weekly, the daily, and the 4 hour is used for one part of the top-down analysis, and then the 2 hour, the 1 hour, and 15 and 30 minute is used for another part of the top-down analysis. So this part is going to be used for the trend to identify if the market is headed to the upside or the downside. And then this part right here, which is the 2 hour, the 1 hour, the 30, and the 15 minute, is going to be used for the entry of the market that you're going to be executing. So you have a top-down analysis to identify the trend and a top-down analysis to identify the entry, which is actually very neat because this way you can actually build an edge and make more money. So when you're doing a top-down analysis, you want to start off on the weekly. I have the monthly here. I don't use it as much anymore. Kind of just look at it every once in a while just to refresh my memory from the beginning ways of my strategy, but I don't use it anymore to be profitable. Haven't used it in a really long time. Just have it there. It's kind of like a superstitious thing, right? I like it. So you want to start off on the weekly time frame. So when you start off on the weekly time frame in the markets, you're probably going to see a market that looks something like this. You're going to see very big moves. You're not going to see a lot of rejections. You're not going to see a lot of movements. It just looks like one big blob of a move. Simplest example I can show you is actively what the market has done right here. It looks like one big blob. So if I were to copy the most recent market structure, it looks like one big move like this. Very easy to identify, not that hard to pretty much see what's going on, right? So this market, you can clearly tell that it was going from bearish to then bullish, and that this market has shifted completely at this section right here. Let me actually just delete this stuff. So you can see how this market has gone from bearish to then bullish. This market was creating lower lows and lower highs, and then we broke this structure level, making this a new higher high. Now we understand by doing a top-down analysis that the weekly time frame is bullish. So it's going to look something like this. Now, when we do a top-down analysis, all we're doing is literally zooming in to the exact same price that you are seeing right here. So this same exact move that we have identified on the weekly time frame that has shifted structure, when we go to the daily time frame, all we literally do is just zoom in. All we do is get a little bit closer, and when we get a little bit closer, what happens? We start seeing a little bit more of the detail of what's going on in the market. So this exact same market move is what's going on right here. And I'm just going to go down to the daily because I've already done the top parts of the analysis. Now I'm going to start working my way down. And when I started from the top, I realized that this market is now going to the upside, or this market is going to the downside, whatever the case is. Then I go down to the daily time frame, and I notice that within this same exact market move, there is a lot of structure that is happening inside here. So all I'm simply going to do is just draw out the structure points following the same weekly move that happened on the section to the upside. So if you notice, this is the same exact move from right here on the weekly, but now this is on the daily. So we can identify from a top-down analysis why it's so important on doing it. Because if we were to only look on the daily, this is what we would see, and we would see a bunch of rubbish. We would see literally the market going up, down, up, down, up, down. It's a bit confusing. But then if we look at the weekly, we get a very clear indication of where the masses of the markets are actually heading. And this is actually very key because you could only focus on what matters. Do you want to only